So in today's video, I'll take some time to talk through my dividend portfolio plans for 2026. Not just what I'm buying, but what I'm doing it. This is not a financial advice. I'm simply sharing my personal journey, especially after going through a lot of volatility, stress, and lessons in the market over the past year. If I'm being honest, dividends were not always a big focus for me. I used to care more about growth, capital gains, and trading opportunities. I wanted things to move fast, but after experience drawdown and uncertainty, I've started to appreciate what is stable, boring returns actually means. Dividends may not be exciting, but they are reliable. And reliability is something you only truly value after things get tough. That is why 2026 for me is about strengthening the foundation of my portfolio. So right now, my dividend portfolio is very simple. As of 2025, I only hold DBS with roughly 30,000 invested. I bought my DBS share in two batches. The first batch was in April, where I bought 300 shares at $42. Then in May, I added another 400 shares at $44 each. So in total, I'm holding 700 DBS shares and my total capital invested is around 30K. At the time of buying, I wasn't trying to time the bottom. I was more focused on buying a quality Singapore bank at a price I'm comfortable holding long term. Fast forward to now, the current DBS share price is around $58. That puts the value of my DBS position at roughly 40K. So just on price appreciation alone, there's around 10,000 in unrealized capital gains. And that is before counting dividends. Some people might say it's too concentrated and they are not wrong because this was a deliberate choice. DBS is something I'm comfortable holding through good times and bad. It's one of the strongest banks in Singapore, well regulated, and it has proven over time that it can generate profits and return cash to shareholders. I don't look at DBS every day. I don't worry about short-term price movement. I treat it as a long-term income producing asset. Every dividend payout reinforces why I hold it. Because even when the market is sideways or negative, the stock is still paying me. So going into 2026, I'm planning to invest a total of 100K into dividend paying stocks. Out of this amount, the remaining 70K will likely go into one more Singapore bank, either UOB or OCBC. The reason I'm so comfortable allocating a large portion of capital into bank is because I believe bank will become the backbone of Singapore economy. Singapore banking system is conservative, well capitalized, and highly regulated. Local banks don't take reckless risks, and historically, they have shown resilience during crisis. Even during difficult periods, Singapore banks have stayed profitable, protect their balance sheet, continue paying dividends, and that consistency is exactly what I'm looking for. By holding more than one bank, I'm not trying to outperform the market. I'm trying to build reluctance and resilience into my portfolio. Right now, I'm still deciding between UOB and OCBC. Honestly, I'm not in a rush to make that call. Both banks are strong banks. Both pay reliable dividends. Both are systematically important to Singapore financial system. So for me, that isn't about which bank is better, but more about which one makes more sense at the right price and timing. When I compare them, I mainly focus on three things: dividend consistency over the long term, valuation at the price I enter, and how well it complements my existing DVS position. This is a long term investment for income, not a short term trade. Because of that, I'm completely okay with waiting. I don't feel the need to force myself into a position just to deploy capital. Patience matters a lot more when you are building a dividends and income portfolio. At this moment, all three local banks, DBS, UOB, and OCBC, are trading near their all-time high. So I'm being extra careful. I don't like chasing the price, especially for banks, and I intend to hold for many years. If I compare UOB and OCBC significantly based on the technical charts, I find myself leaning more towards OCBC. OCBC looks like a clearer uptrend where UOB price action feels more volatile and choppy in comparison. That doesn't mean UOB is a bad bank. It's just how the price is behaving right now. That said, I'm not buying at current level. OCBC is currently trading at $20 and I would prefer to enter only after a healthy pullback, somewhere closer to $18 to $19. That gives me a better margin of safety and improve my long-term yield on cost. I don't want to enter a position where prices are at their all-time high. If the pullback never comes, that is fine too. I'd rather miss an opportunity than overpay for a stock that is meant to provide stability income. On the long term, discipline and patience matters more than speed, especially when the goal is to build strong defensive dividend portfolio. While banks will form the main foundation of my dividend portfolio, I don't want everything tied to one sector. That is where Capital Land Integrated Commercial Trust comes in. CICT gives me exposure to commercial real estate, office, and retail market, which operate very differently from bank. What I like about CICT is that it focuses on prime high quality assets, stable rental income, predictable distribution. It's not a stocks I expect to double overnight, but it's stocks that can quietly generate income year after year. Adding CICT helps to balance my portfolio and reduce the risk of being overly dependent on financial stocks alone. So, when you put everything together, how I'm thinking about my 100k dividend investments for 2026, 30k in DBS already invested, 70k to either UOB or OCBC and CICT. Exposure to CICT for diversification. The exact allocation may change slightly depending on the market condition, but the overall structure stays the same. This portfolio designed to generate consistent income, hold up during market downturns, and reduce emotional decision making. And why does this matter to me? One thing that I've learned over the years is that investing is not just a number. It's about the psychological. A portfolio that consistently swing wow may look good on paper, but it can be very stressful to hold. Dividend stocks help to smooth the experience. They give cash flow, assurance, and give you the ability to stay invested without consistently second guessing yourself. And that is something I value a lot more than before. So for 2026, my focus is clear. I'm building something stable, boring, and reliable. Banks will be my foundation, CICT will add diversification, and dividends provide consistency. This portfolio won't make me rich overnight, but it's something I can hold with confidence for many years. If you are also thinking about building a dividend portfolio in Singapore, hopefully this gives you some realistic and grounded perspective.